Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 31 in our series for 2024, and today's date is Friday, August the 30th. First, I'll be talking to Dana Udall, the Chief Clinical Officer for the Headspace app, which is a leading provider of meditation and mindfulness and well-being solutions. With over 100 million users, 30 million of those from Headspace for Work partnerships with over 4,000 global enterprises. The Headspace app continues to rank in the top 10 most downloaded health and fitness apps in both Apple and Android stores, and has been downloaded over 70 million times with millions of monthly active users. Some notable Aussie brands who are cultivating healthier employee initiatives via Headspace for Works include Movember, carsales.com, A2 Milk, Atlassian, University of Melbourne and Booking.com, just to name a few. We will discuss trends happening within the mental wellbeing space, and I'll talk to EY economist Sherelle Murphy about Australia's inflation and what it means for the Reserve Bank of Australia and the prospect of rate cuts. But first, let's talk to Dana Udall.
Well, Dana, tell us about the mental health issues in the tech space.
Well, we know that we are in really a global mental health crisis. We are seeing many more people raise their hand, many more people who are experiencing mental health issues. The pandemic certainly uncovered a lot of that, but we've seen increases in things like depression, anxiety, suicidality, substance use, and eating disorders. So really, mental health issues have really burgeoned, and we're seeing this across the globe, that more and more people are needing support, more and more people are seeking services. And so that's what we're really trying to do, is to reach folks early, to provide them with skills and to help them manage their mental health needs. You know, I think that for a long time, there were deep mental health needs that weren't discussed. What we have seen really is this sort of move from the shadows to the center, where mental health issues are being talked about much more. So I think COVID uncovered a lot of what was already there, but it did exacerbate it too. We know that those years of isolation for children and adolescents, for example, some of them may have missed some major developmental milestones or opportunities for socialization that have impacted them. So there were things that really got worse because of the pandemic. And even though many of us think of ourselves being out of the pandemic in some ways, that mental health issue, it has a long tail. So we're still seeing it there.
What are the big mental health trends in the tech sector?
Well, what we're seeing is many more people seeking services through telehealth services. So we know that in many parts of the globe, there are just not mental health providers available. So people more and more are using their phones. They are going online, and, you know, we're on our phones all the time, whether it's for banking or talking with loved ones or doing work. So what we're seeing is more and more people wanting to access healthcare and mental health services through their phones. And that might be, again, some of the things that the Headspace app offers, like mindfulness and meditation content, sleep casts, movement exercises, or it might be actual services such as coaching or therapy that can all be obtained through a cell phone. So we know that people are more stressed than ever. We see this in every segment, and they're turning to telehealth to really solve some of those needs.
So they'll be talking to a healthcare provider on their phone.
That's right. And we are just about to release the 5th annual Workforce Attitudes Report, which is a survey that we do. We surveyed CEOs and HR leaders and workers from around the globe to really understand the mental health issues. And we found that many of them actually experience a significant degree of dread and stress on a daily basis. So 89% of employees say they experience moderate to extreme stress on a daily basis. We know that Gen Z is one of the most impacted groups, and they are really feeling this stress, this sense of dread on a regular basis. We also have some really interesting data on Australia in particular. And so what we found for Australians, for example, is that one of the major causes of stress at work is economic uncertainty. This really is impacting folks, making them much more stressed. Burnout levels are also quite high. So again, we're seeing this globally, and certainly in Australia, we know that people are very impacted as well.
So there'll also be issues with coming with financial stress. There would also be issues about sleep disorders.
Yes,
right?
That's right. We've seen a lot of sleep disturbance. It is one of the things that people use our services for most. Early on in the pandemic, we saw a 50% increase in overnight utilization of our coaching services. So we know that people are not sleeping well, and there are profound consequences, mental health and physical health, when people are not sleeping.
Right. So conceivably, you could have someone coming on to you in Australia, and it's 2 a.m. over there, and it's whatever time it might be in Colorado.
That's right. But we need to be available 24/7 because we know that mental health needs happen around the clock.
I mean, how can we best understand tech users and navigate their needs?
Well, I think that we have to meet users where they are, and we have to provide interventions in a way that are really congruent with their lifestyle, that are easy and low friction and accessible. And so for folks that are in the tech segment or folks that are just regular users of technology, again, that can be through their cell phone. So using a technology that is already very familiar to them, that's very convenient, is a key way to really drive engagement. And then reaching people early. One of the things at the Headspace app that we are really focused on is prevention, teaching people lifelong skills like mindfulness and meditation that they can use early on and then over the course of their life, because we know that that can help decrease the length of care if they need it. It can improve outcomes, and it can really improve their experience because then they can have these skills so that they don't necessarily need as much help from professionals.
So what are the barriers?
I think a lot of the barriers are actually solved by telehealth. So there are certainly barriers to in-person care for many places, for many people. But one of the barriers that still exists is stigma. We know that for some populations, seeking mental health support is still considered a little bit taboo. And so part of what we're trying to do is really, again, destigmatize and make these experiences very accessible to folks. But we know that some groups still feel a little bit less comfortable reaching out for help. We also know that there are barriers to care in terms of, if you need childcare, if you have to find transportation and go see someone in person, those are significant barriers. And that's a lot of what we're trying to solve for, is creating a system that is so accessible that those barriers are reduced.
Are there any particular sectors of the tech community that are more resistant to or have more reservations about seeking help?
We work with a really broad population. So folks that are tech workers, folks that are in just about every industry you can imagine. So this might be home healthcare workers, it might be professional services, it might be in retail. So there are lots of different folks that we support. And I don't think that we've noticed any sort of big trends per industry where some folks are more likely to use services than others. So that's not actually something that we've seen.
So it's not necessarily generational and it's not necessarily gender-based.
Well, it's interesting. When we've looked at the data in the past, there are certainly some folks who would prefer to meet in person. But for many people, even across age ranges, they are very comfortable using, we offer, for example, a text-based format in which people can engage with a coach. And so most people are very comfortable with that format because they're texting regularly. And then we offer video-based sessions for clinical care. So I think that surprisingly, we see all ages of folks from all walks of life being really comfortable using those services. And certainly the mindfulness and meditation techniques, all of those things are really accessible. And so we don't see that there is really a barrier. Many people from all different walks of life are able to use those and really benefit from them. We do a lot of research to really establish the credibility of our services. We're really invested in demonstrating outcomes. And so one of the things that we regularly do is research to understand how mindfulness and meditation helps. And we see that there are huge decreases in stress, in anxiety, in depression, and that these tools can really help people be more functional at work, at home. They can be more resourced, more resilient. And that's really gratifying to see because that's our hope. And now we have a lot of data to actually support that.
That's interesting. I mean, do you actually do one-to-one with the workers, or do you actually also talk to, say, their management as well?
That's a great question. So with our services, folks can come on and they can chat with a coach, and then they also could have one-to-one visits with a therapist, for example, with a counselor. So we offer that. And then also through our services, we offer manager training. And some of this will be rolling out in Australia in the near future. But what that means is that we are able to help managers feel more resourced. We're able to help them feel more prepared, because part of our research also has found that managers are very, very stressed. This is something we hear all the time, is that managers are doing a lot of taking care of people, feeling responsible for people, talking about mental health in the workplace. And this is something that managers don't always have a lot of practice with. So we want to support managers because we know that they are really carrying a heavy load right now.
And certainly they haven't had experience with it until recent years.
That's right. Talking about mental health and dealing with these things is a pretty new domain for many managers. So they often feel pretty under-resourced.
Well, speaking of new, I mean, what's interesting is that I think the pandemic has changed our use of technology, such as, for example, Zoom or Teams or anything like that. So it's all technology based now. And that's equivalent to, I think, the change going on in workplaces now with the Industrial Revolution. How do you feel about that?
I think that we are in the midst of so much change. Sometimes it's hard to even acknowledge when you're in it, right? It's easier to sort of see when you reflect or step back. But the degree to which we are reliant upon technology, the degree to which it is integrated into our lives is so profound. And for many people, it has really, again, created access. It has really allowed them to meet with people around the globe, to really have a sort of deepened perspective. But we also don't want to lose that human in-person touch too. So it's important that we are really creating those opportunities for connection in different ways.
And so in a way, it's actually improved the mental health care of people around the globe.
That is definitely what we are seeing, is that folks that are in under-resourced areas. I've lived in rural places in the United States for a lot of my life, and I know that there are not any mental health providers, or there may be a couple, but it takes months to get in and see someone. And so the fact that we can offer telehealth services is really empowering, and it often can help attract folks who might be from communities that might not go in person. So it is really powerful, and we really are in a time of sea change where we are doing much more to support mental health, and people are able to access services much more effectively than they were in the past.
Well, Dana, it's been a delight talking to you, and thank you so much for your time.
Thank you so much. It's been a pleasure to talk with you as well, Leon.
And now let's talk to EY economist Sherelle Murphy.
Well, Sherelle, what do you make of Australia's inflation figures, latest, and what does this mean for the RBA and also the RBA's decision?
Well, look, inflation is coming down, but it is coming down at a very slow pace. And that, of course, has caused the Reserve Bank to, I guess, express some nervousness about the fact that they will get to that 2 to 3% target band in the time that they have allocated, which is basically kind of by mid-2026, late 2026, which is obviously some time where the inflation has been above the band. So they don't have a lot of tolerance for upside surprises. So they've been very hawkish in their commentary, and they have expressed some concern that inflation is still way too high, and they're fighting pretty hard to make sure that it gets down again.
I was very impressed by Andrew House's delivery, where he was talking about false prophets, and basically was saying, don't make predictions, because we're all in a very tough space. We're all struggling to make predictions.
Yes, and look, it is a tough space and it is difficult, but the reality is there are some people out here in the markets and in commercial land who are paid to have an opinion to help guide their clients or their own businesses through. And so while we can certainly be nuanced in our views, and I certainly think that is very wise, we have to be clear that this is not an exact science and there is a lot of art in forecasting. Unfortunately, we can't all necessarily avoid it because some of us are paid to do this. So useful and not useful at the same time.
So what does this mean for interest rates moving forward? I mean, the RBA said for the next 6 months, but is there a prospect with the strong jobs figures coming out? Is there a prospect of, and for that matter, wages figures that are about 4%, is there a prospect of them lifting rates?
Look, you wouldn't rule it out, but it's not my expectation. The Reserve Bank, in their minutes to the August policy meeting, note a lot of uncertainty in the forecasts. They note that they are watching things very closely, but there is that underlying tone of if everything goes to plan, what we've done with interest rates so far should be enough to just keep the path of downward inflation happening. So in other words, you get inflation down from 3.8 to 2.5 eventually. I think it would take something that is unexpected, so not currently in their forecast, for them to raise, which is of course possible. Things do happen. But when we look around the world, we can see that a lot of the other central banks are now getting fairly satisfied with the fact that inflation is coming down, and it's coming down fast enough to satisfy their inflation targets. And a lot of those forces that are affecting them are also affecting us. Some prices are global, some influences are global. level. So I think it would take a shock to get them to raise again. Although, as I say, that of course is possible.
Because so they're cutting rates everywhere, like Bank of New Zealand.
New Zealand last week, yes, and that's sort of mid-August. There is, of course, an expectation that the Federal Reserve will now go in September. That is looking very firm. We've had the Bank of England, European Central Bank, they're all, and Bank of Canada for that matter, they're all, looking now at inflation forecasts which are falling and looking a lot better than they did.
The issue, though, the RBA was slower to raise rates, or slower to raise rates than the other banks, and slower to recognise what was happening with inflation.
Yes, although marginally. I think one of the bigger issues when we make comparisons to other banks is that we didn't lift rates as far. So, in other words, if it was a like-for-like comparison, and it's not, but if it were, even then, the other central banks would have to sort of bring them down a little bit just to get to the Australian 4.35% before we're kind of comparable here. So, but look, that's a kind of a false comparison, because clearly there are different underlying interest rate structures that affect their economies. In Australia, we rely very heavily on variable rate mortgages. In the US, they don't. So our interest rates do tend to have more punch, to the economy than in the US, if we were to make that comparison. And so just kind of saying because the Fed does it, we should do it too, isn't right. And then there's also domestic factors like what's going on with housing, which is a little bit different as well.
So what are the main forces now driving Australia's inflation?
It's still largely a services situation. So it's services inflation, which is too high. Goods inflation has certainly shown some decline from quite a high base. So, and that is worrying because that tends to be domestically driven. And it is the kind of inflation that the Reserve Bank can do something about, if you like, by raising interest rates or keeping them high. It can put downward pressure on that domestic service-driven type inflation. Also, our housing situation is, clearly still a big force on inflation. So both utilities, albeit the governments around the country are trying their best to bring down the price of electricity, but rents are still rising at high rates. Insurance is still rising at a high rate. Even things like restaurant meals are still, expensive and growing at a fairly high rate. So these are the things, I guess, that the Reserve Bank can quash to some extent, which is exactly what it's trying to do by leaving rates at a fairly high rate.
Although issues like housing prices and rents are structural issues because of issues of our housing crisis, and the Reserve Bank can do very little to address that.
That's correct. I mean, you're right. And, there is an issue, which I'm sure you've heard the Reserve Bank governor talk about, which is the fact that our rents are more of an upward influence on the CPI than they are in other countries because of the way the ABS measures them. And that kind of puts a bit of upward pressure on the CPI here, which might not be seen in other countries. Having said that, it's all kind of part of the mix. None of these things are completely independent from the other. So in COVID, obviously, we had people looking for bigger homes. They wanted to live in households with fewer people in them. To some extent, that is kind of unwinding a little bit as people are sort of feeling the pinch in terms of their household budget. So, kids staying at home for longer, yippee. Teenagers and 20-somethings, perhaps also they are more inclined now to move into group housing, which during COVID they weren't. There are some adjustments that can be made here. Not to say that that's necessarily hugely desirable, but the Reserve Bank is, I guess, trying to clip the economy where it can, and that is one of the areas.
So what's the prospect for interest rate cuts? Are we actually talking 6 months' time or later?
Look, it's certainly, I think, looking minimum 6 months now. Their wording and their language around what they intend to do with interest rates has been quite clear, actually, surprisingly so, at least to the extent that they don't expect to deliver a rate cut this year, which, as you know, Leon, has been in line with their expectations through the whole year. We couldn't see them doing that given these ongoing upward pressures on inflation. But looking into 2025, we definitely need to see some significant progress on inflation coming down before they're going to be satisfied that they can cut. That doesn't necessarily mean that inflation has to be below 3%, but it has to be on a clear trajectory to get there. And once the RBA sees that, I think they'll be more comfortable with a rate cut.
So given the trajectory of inflation globally, do we expect to see that happening in Australia where it's coming down?
Certainly, we have good reasons to suspect that inflation will continue to moderate from here. There are the rate hikes that the Reserve Bank have already put in place are still flowing through the economy. As you know, there are long and variable lags with monetary policy. It does take some time for them to have their full impact. We've sort of still got the tail end of those households who are clever enough to fix their mortgages during COVID move back onto variable rates. That is something that inevitably, of course, slows down consumption because more money is required to pay the mortgage all of a sudden. And the labour market is showing some signs of softening, albeit very, very mild. But it is, job ads, for example, are not nearly as high as they were sort of 18 months ago. So there are certainly reasons to expect that the economy or demand in the economy starts to kind of fall down a little bit further, and that should have an impact on inflation. So look, I think yes, we're getting there, but yeah, it's a slow process.
And so the RBA would be very focused on the sustainability of that drop in inflation.
Yes, that's right. And in that vein, they've been clear that any decline in the headline inflation rate that comes through from governments around Australia having put in place subsidies for rent or for electricity rebates, that sort of thing, these changes are temporary. And the Reserve Bank has said that we'll look through that because in a year they go back up again, and that actually causes inflation to go up, all else equal. So yes, absolutely, we need to kind of look through this and look at that longer term trend and where the economy is leading rates, not just where administered prices are leading inflation.
I'm very heartened by the wording, the RBA now, because it seems to be much more precise than before.
Yes, I think that's true. I think in talking about the possible or the unlikely outcome, which is that rates are cut in the next 6 months, the governor was quite clear and trying to give the market a real steer away from pricing rate cuts in September, October, November, whenever it may have been priced at the time that she held her press conference. And that, has had some impact on the markets, although I will say that the markets are still pricing some probability of a rate cut this year. I think they're going to be disappointed though.
As you say, some people are paid to make predictions.
Indeed they are, and I'm one of them.
Well, Sherelle, it's been fantastic talk to you. Thank you so much for your time.
My pleasure as always, Leon.
So what's happening in the news? Well, inflation in Australia has fallen to its lowest level since March, pulled down by a 5% cut to electricity prices as billions of dollars in government rebates kicked in. Consumer prices fell to 3.5% in the year to July, the Australian Bureau of Statistics said on Wednesday. That compared with the 3.8% pace reported for the month of June and the 3.4% rate expected for July by economists. Slower increase in petrol costs, rising by only 4% compared to 6.6% in the year to June, helped bring travel costs and inflation down towards the Reserve Bank's target of 3% overall. And almost 1.6 million Australian households are now facing insurance stress, with a rising number of families experiencing extreme cost pressures as insurers raise premiums in response to inflation and catastrophic weather trends. New analysis from the Actuaries Institute shows insurance premiums have soared in recent years, with more than 15% of households now under insurance stress. Stressed households are defined as those who face paying 1 month's income to obtain their most basic insurance. The Actuaries Institute says an extra 376,000 households have fallen into the distress category over the past year as insurance premiums surged. It found affordability had worsened for all insured customers in Australia, with a 9% lift in the median premium. All major insurers reporting over the past year have revealed spiralling premiums in response to inflation and cost pressures. Suncorp reported a 13.9% jump in its premiums to $14.1 billion as it unveiled its full-year earnings last week. Rival insurer QBE said its Australian Pacific customers had seen a 9.9% lift in premiums. Meanwhile, Insurance Australia Group, which runs brands including NRMA, RACV and CGU, told investors last week it had pushed through a 12.8% lift to Australian premiums last year. IAG also reported it was seeing an increase in distressed customers. Report author Sharanjit Padam said many insured customers had seen their premiums rise, and those with already expensive cover faced even steeper price rises. Increases in premiums are outpacing wages growth, he said. Unfortunately, we expect this will continue because of the overall increasing risk of natural disasters associated with climate change, which will continue to put upward pressure on premiums. And airlines and airports will be made to pay for unreasonable flight delays and cancellations under sweeping changes outlined in the federal government's long-awaited aviation white paper. The largely ineffective airline customer advocate will be replaced by an aviation industry ombudsman scheme, which will enforce a charter of customer rights. These include the right to refunds across all fare types in the event of an unreasonable flight delay or cancellation, the right to prompt payment of refunds, and a minimum standard of customer service. The paper, considered a policy blueprint for aviation reforms, acknowledged airlines and airports needed to lift their games to support customers, handle complaints, and provide refunds. It was noted the airline-funded customer advocate had largely failed to fix such problems, with fewer than 40% of complaints resolved in the last year. A customer rights charter would set out what length of time was an unreasonable delay and what amounted to appropriate treatment of customers in circumstances such as when flights were disrupted. This included entitlements to refunds rather than travel vouchers, no matter what the fare type, for excessively delayed or cancelled flights, and appropriate timeframes and methods for providing refunds. Airlines would also be expected to be transparent about the cause of flight delays and cancellations as part of regular reporting to the government. Carriers are currently not required to pay refunds for delayed flights, with some providing food vouchers to affected customers or overnight accommodation if required. An ombudsman would oversee airlines and airports' compliance with the Customer Rights Charter and deliver an external dispute resolution service. Supported by legislation, the Ombudsman scheme would have the power to direct airlines and airports to provide remedies to consumers, including refunds, and refer instances of misconduct for investigation and enforcement. The changes followed an extensive period of disrupted travel for customers. And more Australian mortgage holders will enter arrears over the coming months as a cocktail of higher for longer interest rates and an expected pickup in the country's unemployment rate push many over the edge, according to S&P Global. The expected pickup in arrears for the rest of 2024 comes after Australian RMBS mortgage arrears fell during the second quarter to 0.95% amid many households cutting expenses to the bone to prioritise essentials such as home loan repayments. S&P Global noted that households' prudence in reducing discretionary spending to stay on top of non-discretionary expenditures, including mortgage repayments, had helped to keep mortgage arrears low. Other key factors contributing to this resilience are low unemployment, rising property prices, and refinancing opportunities, while the use of offset and redraw facilities was easing cash flow pressures and limiting mortgage arrears. The report by S&P Global warned, however, that arrears were yet to peak, with the lagging impacts of rising unemployment yet to emerge. The persistence of higher interest rates will see more borrowers enter arrears as unemployment rises. This will lead to an increase in arrears in months ahead because they are a lagging indicator and one of the last places where financial stress manifests, it said. Hopes for relief from the RBA were blown this month after the central bank's governor Michelle Bullock said there wouldn't be any cuts to the cash rate in the next 6 months as inflation continued to prove sticky. Inflation climbed to 3.8% in the year to June, up from 3.6% in the quarter prior. This means struggling homeowners will be under pressure for longer and could be squeezed even further if the RBA hikes in a bid to kick inflation lower. Rising arrears in New South Wales and Victoria partly reflect greater levels of leverage required to access property markets relative to income, and higher property taxes added to cash flow pressures, S&P Global said. Western Australia had the highest arrears rate in the country of 1.2%. And Jim Chalmers has attacked Peter Dutton as the most divisive leader of a major party in Australia's modern history, who is deliberately undermining cohesion and preying on social fractures for political advantage, positioning himself ahead of the election as a treasurer who can take on the alternative Prime Minister. Dr Chalmers, considered a future Labor leader and potential successor to Anthony Albanese, used a major pre-election speech on Monday night to warn economic dislocation is triggering waves of global violence fanned by fragmentation and destructive leadership. The 46-year-old also said Labor's stage-through tax cuts overhaul was his proudest moment and outlined his blueprint for a fourth economy led by artificial intelligence, a bigger care economy, 90% of electricity globally generated by renewables by 2050, and a bigger, more influential Indo-Pacific region. Invoking patriotism and national security in reflections on former Labor Prime Ministers John Curtin and Ben Chifley, Dr Chalmers conceded there's a lot at stake and we don't take any outcome for granted. With polling indicating plunging support for the Prime Minister and Labor tracking towards minority government, Dr Chalmers defended his economic management during a cost of living crisis and higher inflationary environment. He said the coalition was wrong to criticise Labor spending in the budget and flagged that Labor was not preparing a spend-a-thon to woo votes ahead of a tight election. In a politically charged speech at the Labor-aligned John Curtin Research Centre in Melbourne, Dr Chalmers launched an extraordinary assault on the opposition leader's readiness to lead the country, while acknowledging the government faced a tough re-election fight. The attack followed a heated 2 weeks in Parliament, headlined by Mr Dutton heaping pressure on Anthony Albanese over claims the government did not impose adequate security checks in fast-tracking thousands of tourist visas for Palestinians. If anything, Dutton wants higher inflation, higher interest rates, higher unemployment, lower wages and less help. We are now well into the third year of a 3-year parliamentary term and he's still ticked precisely none of the necessary boxes. The Rankin MP, who mentioned Mr Albanese's flagship Future Made in Australia policy once in the speech, warned that manufacturing had crashed from 15% of output in the 1980s to 5% in the 2020s, referencing a quote by former Labor Prime Minister Paul Keating about Australia's first 3 economies. Dr Chalmers mapped out his vision for a fourth economy, driven by energy, technology, demography, industry and geography. And months after a sometimes fiery inquiry into supermarkets giant Coles and Woolworths wrapped up, the Senate's Economic Committee has called a new probe into big box retail chains selling household items outside the reach of the food and grocery sector's code of conduct. In May, the supermarket inquiry recommended a separate probe into big box retailers, warning of creeping acquisitions by major players. It said the competition watchdog, the Australian Competition Consumer Commission, was only becoming aware of the issue of buy-ups when they were notified of larger merger plans. Voter frustration at the high cost of living is driving populist politics around the world, even prompting Democratic presidential nominee Kamala Harris to promise a ban on corporate price gouging on groceries if she wins the White House in November. Critics of big business in Australia, including the Nationals and Greens, want better prices for consumers and suppliers, goals that could be contradictory and would reduce profit margins. Former Labor Minister Craig Emerson opted not to add the Wesfarmers own Bunnings, Chemist Warehouse or online giant Amazon to the grocery code in recommendations of its review commissioned by the Albanese government. Bunnings Managing Director Mike Schneider was criticised in the Senate Supermarkets Inquiry report for not appearing to give evidence in person and now faces another request to appear in Canberra. In April, he said, Bunnings should not be covered by the grocery code. Bunnings' profits surged 40% during the COVID-19 pandemic as many Australians turned to home improvement to pass the time. Wesfarmers will announce its latest full-year results on Thursday, and Bunnings' profit margins will be closely scrutinised. The new inquiry could become another flashpoint on cost of living ahead of next year's federal election. Liberal MPs have privately expressed apprehension about the inquiry and the Nationals' influence over opposition leader Peter Dutton's proposed break-up powers for supermarket giants. And the profit reporting season is ending this week. BHP has posted an underlying net profit of US $13.7 billion for the 2024 financial year. The newly listed Guzman y Gomez's net profit after tax on a statutory basis for 2023-24 came in at a loss of $13.7 million, but that was 15.1% ahead of forecast, while on a pro forma basis, net profit was $5.7 million, 71% ahead of forecast. Johns Lyng Group's net profit increased to $63.3 million, from $62.8 million in the prior year. Jewellery retailer Lovisa's net profit jumped 20.9% to $82.4 million. Supermarket giant Coles' net profit rose 8.3% to $1.1 billion in fiscal 2024 from a year ago. Before significant items, Woolworths net profit fell 0.6% to $1.7 billion in the 52 weeks to June 30. Woodside's underlying net profit fell 14% to US $1.632 billion in the 6 months ended June 30. Hotel booking software company SiteMinder has narrowed its statutory loss from $49.3 million in FY23 to an after-tax loss of $25.1 million for the full year ended June 30. Novated leasing and salary packaging business Macmillan Shakespeare Group reported a 39.7% increase in full-year net profit from continuing operations to $90.06 million. NIB Holdings reported a 67.4% increase in full-year net profit to $181.6 million. Aussie Broadband reported profits up 21% to $26.4 million. Pilbara Metals profits fell 89% to $257 million from $2.39 billion. Bendigo and Adelaide Bank cash profits have dived 2.6% to $562 million. Payments terminal player Tyro has quadrupled after-tax profits to $25.7 million. Viva Energy's profits rose 10.3% to $192 million. Online beauty retailer Adore Beauty swung to a net profit of $2.2 million from a loss of $559,000 a year ago. Wealth giant Perpetual will write down more than $500 million in fair value losses in the 2024 financial year. Queensland Coal Export Terminal Dalrymple Bay Infrastructure's interim net profits rose 8.3% to $36.8 million. Kogan's net profit after tax was $83,000 compared with a loss of $25.9 million a year ago. Infomedia's profits jumped 32% to $12.7 million. Bus and ferry operator Kelsian Group forecasts its profits to jump 176.2% to $58 million. Endeavour Group, owner of Dan Murphy's and BWS chains, posted a net profit which fell 3.2% to $512 million. Investment firm Regal Partners generated a first half net profit to $50.2 million, up 349%. Wealth platform Premium announced a statutory NPAT of $8.8 million, up 42% on 2023. Chorus reported a net loss after tax of $9 million. Zipco's revenue increase 285% in the year ended June 30 to $868 million, and its transaction volume rose 14% to $10.1 billion. Propel Funeral Partners reported an operating net profit of $23.4 million, up 12.2% for the 2024 financial year. Integral Diagnostics swung to a statutory loss of $60.7 million for the 2024 financial year, having posted a $25 million profit in the prior year. Global Engineering Group Worley's underlying earnings rose 24% to $751 million. SG Fleet reported a 6.7% rise in profit after tax to $89.7 million. Nanosonics reported a gross profit of $132.4 million, up 1% on FY23. Bed linen, pillows and cushions retailer Adairs reported a 17.8% drop in net profit to $31.1 million for 2023-24. APA Group's net profit before one-off items fell 58.5% in the year ended June 30 to $119 million. Nine Entertainment posted a profit of $216.4 million. Mining company Fortescue Metals net profit jumped 18% to US $5.7 billion, that's $8.4 billion Aussie, in fiscal 2024 from a year ago. City Chic reported underlying EBITDA loss of $8.4 million, which was a 47.3% improvement on the prior year. Flight Centre's underlying profit soared by 131% to $320 million. Tabcorp posted a net loss of $1.4 billion. Smart Group Corporation posted an operating EBITDA of $56.2 million, up 20% on the previous corresponding period. Kelsian Group posted a statutory net profit after tax, up 176.2% to $58 million. Karoon Energy posted a statutory net profit after tax of US $61.8 million, down 50% on the previous corresponding period. Data center operator NextDC boosted its underlying earnings to $204.3 million. And that's it for this week. And next week I'll be talking to Evan Thornley, the co-founder and executive chair of Longview, the fund that allows property investors to invest in a slice of the more lucrative, better performing family home market without either the hassle of being a landlord or owning the entire property outright. And I'll be talking to economist Nicholas Green about how central banks around the world, including our Reserve Bank Australia, can make better economic forecasts. The most exclusive access to leading economists and business leaders from around the world. Subscribe to Talking Business from our website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all email. Also, in my copious spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or advertorial, email me. Wishing you all a safe and healthy week and looking forward to bringing you Talking Business next week.